Did you know that TSP is coming out with a new feature called in-plan Roth Conversion, which allows you to convert your pre-tax dollars to your after-tax dollars within the plan? Traditional TSP has been around since 1987, but the Roth TSP was not introduced until 2012. And here we are in 2025, finally getting ready for something brand new. And let me show you the updates on the TSP in-plan Roth conversion that will begin in 2026. And trust me, this one could be a game changer if you play it right. But before we dive too deep, if you missed my video back in June about the in-plan Roth conversion, go check that one out first, because in that video, I laid the groundwork for how this whole thing is going to work. And today's topic is more of an update, and I'm going to answer some questions that came up and give you the latest details straight from TSP and share my honest thoughts on what this could mean for you. TSP just made an official announcement confirming what I already suspected, but I want to make sure you know about it too. So let's start with the elephant in the room, and that's the taxes. Anytime we talk about Roth conversions, taxes are the first thing people ask about, and for good reason. The TSP just put out an official announcement that basically confirmed what I suspected all along, but it lays out the rules of the road, and I want to make sure every single one of you understands them. They announced that starting in January 2026, this Roth in-plan conversion will be live. What this means is you can take a chunk or all of your traditional balance and move it over to the Roth side of your TSP. And here's a nice little detail. If you have never contributed to a Roth TSP before and don't even have that part of the account set up, your very first conversion will automatically create it for you. Simple enough. But the most important sentence in their entire announcement is, you must pay the income tax on the conversion amount using personal funds from another source, such as a savings account. You have to pay the taxes from your own pocket. This is the single biggest hurdle you're going to face, and the one that requires the most planning. And get this, as of July, the entire TSP is sitting on over $1.02 trillion, and that money is spread across 7.25 million of you. But the thing is, out of that massive $1 trillion pot, only $81 billion is in the Roth TSP. And it's not just the amount of money, it's the number of people. Out of all 7.25 million of you, only 2.82 million even have a Roth balance to begin with. Think about that. The average person has a Roth balance of just about 35,600, while their total average account is over $205,000. That tells you right there that the vast majority of people's money is sitting on the pre-tax traditional side. And if you look at the folks under the older CSRS system, the numbers are even more lopsided. And out of 229,000 accounts, a tiny 8,800 accounts have any Roth money at all. Their average Roth balance is a bit higher, around $43,400, but it's clear that almost no one in that group is using it. But then you have the military. When I was in the Air Force, I started my Roth TSP contributions around 2014, and nearly 3/5 of our veterans have money in a Roth TSP. So what gives? It's simple, really. A huge chunk of their income, housing allowances, and food allowances is non-taxable. They only pay income tax on their base pay or bonuses. So for them, putting money into a Roth is an absolute no-brainer. But the real reason your Roth balance is so low comes down to one simple thing, and that is the default setting. When you were hired, the government automatically started your contributions into the traditional TSP. You had to actively go in there and manually choose Roth. So when you do an in-plan Roth conversion, you are taking money that has never been taxed, and you are, in the eyes of the IRS, realizing that income in the year you do the conversion. That means it's added to your total taxable income for that year. So let's use a simple example. Let's say in 2026, you decide you want to convert $10,000 from your traditional TSP to your Roth TSP. And let's assume you are in the 22% marginal federal tax bracket. And that means that $10,000 conversion is going to cost you $2,200 in federal income tax. So that's $10,000 multiplied by 0.22. Now, as we established, the TSP is not going to withhold that $2,200 on your behalf. The full $10,000 will move from the traditional side to the Roth side. So what do you do about that $2,200 you owe the IRS? So you basically have three options. First, you could make a quarterly estimated tax payment directly to the IRS. you would essentially just write them a check or make an electronic payment for $2,200 to cover the liability from that conversion. This is the cleanest way to do it and ensures you won't face any under withholding penalties. And second, you could just wait. You do the conversion, and when you file your 2026 taxes in the spring of 2027, you will find that you owed an extra $2,200. You can pay it then in one lump sum. The risk here is that if the amount is large enough relative to your total tax liability, you could get hit with an under withholding penalty, assuming that you have all of your tax deductions and credits calculated to your overall income. The IRS does not like it when you wait all year to pay them what you owe. Your third option, and a pretty practical one for many, is to adjust your tax withholding at your job. And you can update your Form W-4 and have your employer take a little extra tax out of each paycheck for the rest of the year to cover that $2,200. But wait, we've only talked about federal taxes, and most of you also live in a state with an income tax. So if your state income tax is, say, 6%, you're going to owe another $600 on that $10,000 conversion, because that's $10,000 multiplied by 0.06. Your total tax bill for this move is now $2,800. And just like with the feds, you might need to make a separate estimated payment to your state's Department of Revenue to avoid any penalties on their end. The bottom line here is that you must have the cash ready and available to pay the taxes on any amount you convert. Before you even think about doing this, you need to sit down maybe with a tax professional and figure out exactly what your marginal tax rate is and what the bill will be. Now, this brings me to one of the most common questions I got from my subscribers after my last video. What about my employer match? Can I finally get that in Roth? The technical answer is still no. Your agency's matching contributions, that free money they give you, will continue to go into your traditional TSP balance. But this new in-plan conversion feature gives you a brilliant workaround. You can now effectively turn your match into Roth money yourself. Let me explain how. Imagine it's late 2026 and your last paycheck lands in your bank account on Friday, December 25th. That check contains your final TSP contribution for the year. Let's say the total match they give you for all of 2026 was a nice round $5,000, and it's all sitting there on the traditional side. Sometime in the last week of the year, you log into your TSP, you find that new in-plan conversion button, and you tell it to move exactly $5,000 from your traditional balance over to your Roth balance. Maybe it's more than $5,000 because of the earnings and interest that you earn over the year. You are essentially grabbing that year's match and moving it over to the tax-free side. Now, the timing here is absolutely everything, because you made that move before the ball dropped on December 31st. The IRS sees it as a taxable event for 2026. You will handle the taxes for it when you file your 2026 return. If you procrastinated and waited until the first week of January 2027 to make that conversion, well, guess what? You've just created a taxable event for the next year, 2027. That 1 week of difference is huge. So just like that, you can literally convert your match money at the end of every single year, taking control of money you previously could not touch and putting it on the path to becoming 100% tax-free. After you do this, sometime at the end of January 2027, you're going to get a tax form in the mail or electronically if you're set up that way, called a 1099-R. Normally, this form is used for retirement plan distributions, but in this case, it will still show the total amount you converted during the year, and it will have a special code on it that tells the IRS, hey, this was a conversion, not a withdrawal. That way, you don't get slapped with any early withdrawal penalties. You will just owe the regular income tax. And think of it as the official receipt of the transaction, and you'll need it when you file your taxes. One thing the TSP has not announced yet is how many times per year you can make these conversions. We do not know if it's unlimited, once a month, once a quarter, or what. I will be watching for this update and will let you know as soon as I hear anything, so be sure to subscribe if you haven't done it already. If I had to guess, I would bet they'll treat it very similar to how they treat fund reallocations, meaning you might be able to do it once or twice a month. So the next logical question is, who exactly is eligible for this? Who gets to play? The guidance from the TSP is pretty clear. The option will be available to all active federal employees or military members, separated participants. So if you have left federal service but kept your money in the TSP, and spousal beneficiaries who have an inherited TSP account. Basically, if you have a TSP account with a traditional balance, you're in. There are a couple of ground rules though. First, there's a minimum conversion amount of $500. That means you cannot just move, let's say $50 over. Second, as long as you're actively employed, you can only shift money from your traditional TSP over to your Roth TSP. That's it. This is not some backdoor way to funnel money into a Roth IRA at Fidelity or Schwab while you're still on the job. The dollars stay inside a TSP. The only time you can move money out while you're still employed is if you're over 59 and a half or if you qualify for a financial hardship withdrawal. And trust me, these rules are pretty strict. Now, once you have retired or separated from service, that's a different story. At that point, doors open and you've got more rollover options. Look, making a Roth in-plan conversion can be an incredibly powerful tool. You pay the taxes now on your own terms, and then all of that money plus all of its future growth is completely tax-free in retirement. On top of that, Roth money is not tied down by required minimum distributions. And those RMDs are the ones that force you to start pulling money from traditional accounts once you hit that age. And that means more control, more flexibility, and fewer headaches down the road. But it all comes down to that initial tax bill. You have to be ready for it. So please talk to a qualified tax professional in your area before you pull the trigger on a conversion. They can help you figure out your tax bracket, calculate the exact cost, and plan the best strategy for your specific situation. It may not make sense for you to make the in-plan Roth conversion depending on your age or when you're looking to retire. And the bottom line is that this feature opens up a whole new layer of flexibility, and it lets you take those pre-tax dollars that have been building up for years and flip them into a Roth without leaving TSP. But it's not free. You have to pay the IRS. It's cut up front. So start planning now. Look at your tax bracket, run the numbers, talk to a tax advisor, figure out how much you could afford to convert without blowing yourself up on taxes. Because if you do this smartly, it could save you a lot of money down the road and give you more control over your retirement income. And this has been another beast of a video, and I hope you got a lot out of it.